Good afternoon, ladies and gentlemen. I was trying to do a little bit of a Powell impression there. He always walks up and he's just like, good afternoon. And then the market just goes all sorts of crazy ways. So, team, welcome back to the Jerome Powell stream today. We are going to get that interest rate decision in about 15 minutes here. I kind of wanted to come on a little bit earlier to make sure that we were kind of last minute prepared, making sure nobody's doing anything crazy. But team, I mean, it's that point in the day. Do a little bit of a roll call. We'll do a part 2 today. Say some good afternoons to everybody in the live chat. If you guys would like to say good afternoon to me, I'd appreciate it as well. But this is going to be a very, very interesting afternoon. Very interesting afternoon. Oh, can you guys see me? Are we good? Are we good? We're good. All right, team. Let's see who's in here. As always, make sure you guys are hitting that like button on the way in. Helps out a whole lot getting these streams out to some more people. Remember, guys, we are live every single day at 9 a.m. streaming the market. We come on again now just because it's Powell. But a couple updates. DraftKings sold off from the highs. Happy I was able to take off and make that whole position free with some profits there. Still waiting to see if we can get up to that level, that 45.61. It's free. Expires this week, so don't really have to do anything with that. I got AMD up here just to kind of gauge what some of the chips are going to do. Actually, we probably should have NVIDIA up here instead because NVIDIA's got an interesting look to it. We're going to have KRE up here as well. This is going to be the regional banking ETF. This is going to be very interesting to watch how this moves. When Powell, you might get a question about BTFP, the Bank Term Funding Program. Dude, all right. First of all, I get it. Everybody's coming in here saying wild stuff because it's FOMC. At least hit the like button. All right. How about that? Why are all the meme coin people in my Twitter replies talking about some random Powell coin? Can we not, please? Can we not do that? It's a bit silly. Come on, guys. I get it. You guys want to have your fun. But please, let's keep it in the zoo. All right. Can we not be doing that today? Stop. All right. We're gonna have if you guys go crazy with that type of stuff, we're gonna have to ban it. We can't. There's no pumping of any kind in here. Don't be a dum-dum. You're here to learn. I understand that you guys wanna just like play hot potato with all this money and hope that you get out early. But can we just relax a little bit, everybody? Let's see what we got here. Daily Taylor, Rogue, Wreck-It Ralph, Cody, Scott, AJ, Tor, Stefan, who's trying to pump over here, Eddie, AR guy, Kevin, what's up, everybody? How we doing? Oh, God. All right, team, again, keep smacking that like on the way in. So here's what we're looking for the interest rate decision. The overall expectation is that they're not going to be moving interest rates at all, up or down. But with the increased levels of the hot inflation readings that we've seen over the past couple of weeks here, when Powell starts to come out, and even in the written report, I would expect Powell to change his tone a little bit. So he's probably going to lean towards more of that data dependency, saying that we don't know. We think we're at our peak interest rate of this cycle. We do think that it's possible that we're going to be bringing down interest rates this year. And I think he's going to get directly asked the question, how many? How many are the Fed speakers really expecting to happen here? Been a minute since you've been on. Nettie, where you been? I'm live every day at 9 a.m. What are you guys doing? All right, let's see. So what do we got? 12 minutes to go here. I mean, DraftKings is coming back. That's fine. That position's free. Yeah, how's the ES doing? Nothing. Guys, remember what I was saying this morning? Everybody was like coming into the live stream and pre-market being like, Ralph, stop. Everybody's coming to the live stream like, oh my God, are you going to trade it yesterday? No. Why would I trade? It's been in like a 15-point range. Tax season? Oh, that's fair, Nettie. That's fair. Tax season's rough. It's rough for me too. I'm not having fun. I have nightmares about tax season. I don't sleep much. No, I'm just kidding. I'm just kidding. All right. It's going to be a fun afternoon, team. NVIDIA, I would be interested in if we get some overall market exuberance. It'd be a quick flip over the next couple of days. If you do see a really positive reaction to the FOMC meeting today, it's possible that could reignite that little AI and chipmaker hype that we've seen. AMD has been aggressively beaten over the last couple of days here, which is no fun, but you know. Ralph, you need to use the safe. What's the safe word? I'll call the SEC on you. Like, is that the safe word? I'll just make a phone call. Like, let's see. You're here for the free air fryer? Well, that's crazy. Whoa, we got a lot of you guys in here this afternoon. Welcome, everybody. Again, all I ask for over here is that if you guys wouldn't mind hitting that like button, it makes it easier to find the streams when we do. What the heck was that? When we do them again, I think somebody's trying to break in. It's probably the meme coin people trying to hop on the stream, be like, hey, talk about our coin. It's like really got a lot of utility. It's Jerome Powell, but it's a cartoon. Oh, you're from India? What's up, man? How you doing? Swing King, and you don't know. Stop. We're not playing this game. So 10 minutes to go here, ladies and gentlemen. Which direction will gold move on FOMC? Well, if I knew that, I'd be a billionaire. If I knew what the reaction was going to be like off of a binary event, I'd be a billionaire. Not a billionaire, so we don't know. Guys, again, there's no way to predict which way the movement's going to be, even though we have our expectations on what they're going to say. You never know how the market's going to react. So that's why we've been so like just kind of relaxed over the last week and a half after hot CPI and PPI, just letting things fizzle out until we make our next decision, man. That's kind of what we're looking to do. See which direction the market really wants to go and then make our decisions from there. Oh, thank you, Squirrel. We are not playing this game. No, we're not. We're not playing the game. All right. DraftKings coming back. That's nice. I don't know. What is that position now up? It's that's funny. Hold on. What is that position up? 35% right now. That's fine. That's fine. Where am I from? I live in Boston, but I'm from Connecticut. From Puerto Rico. Oh, is everybody going to start saying where they're from now? All right, here we go. I remember we used to have this issue when we had like 3, 4, 5,000 people on the stream where one person would say one thing. I forgot about that. Like you'd say one thing and then everybody would be like, my name is this, or I'm from here, or this is my age. I forgot. Maybe we're going to have to start dealing with that soon as more people start coming back to the streams, which looks like it's happening. So, I mean, DraftKings, that was a good trade. I scaled out, made that trade free this morning at 300%. Well, I mean, the scale out I think was around 270, but it was still really good. So that's free. Even if that position went completely to zero, I've still locked in. I took my initial investment back, got some profits on it as well. I believe it was around like 23% total. Looking to see what it can do on FOMC now, potentially getting up to that 45.61. I was in this one yesterday. That was a pretty good one. KRE is a little bit of a longer term one. If the regional banks start to have some issues, especially with what's happening in the office space section of commercial real estate, which a lot of those buildings could easily start getting returned to the banks pretty soon. And if the Fed does not signal that they're still on the same track to start cutting rates, it's going to be very, very difficult for those regional banks to honestly stay intact. If the Fed starts to cut rates and lending activity picks back up, the smaller regional banks can kind of offset some of their losses with more lending activity. But if that's not going to happen, then they're going to have some issues. If you're trading FOMC, should you buy contracts that expire tomorrow or today? If you're trading FOMC, first of all, you're an insane person. Second of all, if you want to be absolutely insane, you buy contracts that expire today. If you want to be still really clinically insane, you buy contracts that expire tomorrow. But I mean, I'm not going to do anything. I'm not trading FOMC. What am I, an insane person? No. We've been talking about this day for like the last 2 weeks. We need to really sit back and figure out break down what they're saying and see what the market reaction is going to be like. Because if you look at ES on the daily, if I just saw this as a single stock, I'd be ready to take this thing way higher. Ready, like new all-time high breakout, nice little consolidation setup, even though it's been a little choppy. You just have to see where the market wants to take this thing after not only the interest rate decision, but the Q&A session that we're going to be getting. So 6 minutes to go until that interest rate decision. So here's what happens first. I know a lot of you guys are new here. Oh my God, you guys are going to, I don't understand. Guys, I'll tell you guys this right now. I have a very, very well-versed background in finance. I've been doing this since I was 14 years old. You guys stick around the stream long enough, you're going to learn a lot of things. Here's what I don't know how to do. Buy meme coins on Solana. I know how to do them on ETH. I do not know how to do that on Solana, and I don't want to. So can we please stop with the meme coin nonsense right now? I get it. You guys are all pumpers that don't know what you're doing. You're like, we need more people. I got it. Everybody knows. The SEC's watching too. Just stop. Just relax. We have more important things to do right now, okay? Lizard people are real too. Yeah, I know. I get it. Everybody likes to gamble. That's not what this is. Look, you're looking for some monster shark candles? It'll be interesting. It's okay, bro. We'll take you to the No. Don't loop me into your stuff too. Don't be doing that. I don't want it. Because like if I come in and throw 10 grand around, then I'm just everybody's exit liquidity. So no, we're not. Sorry. Like we've been talking about IPOs a lot over the last couple of weeks. Why don't we want to buy IPOs? Because you're literally everybody's exit liquidity. This situation that you guys are bringing up in the live chat is honestly even worse. What broker I used? Trade-of-8, Ninja Trader, and Webull. Showcase Minerals. Is that like a commodity? I really hope it is, and it's not like a garbage coin. Good afternoon. What's up, guys? We got 4 minutes here. Thoughts on the FEPI ETF? I don't know. Frank, what's up, buddy? Let's see. I feel Frank. What is this? All right. Maybe I'm like thinking of a different Frank. I don't know. What is this? Income? What's their yield? 20? What do they do? Is it a covered call ETF? Are they selling covered calls on FANG? Because they have a yield of 20. That's kind of crazy. If it's that high, they're probably selling. This chat is, dude, this is the craziest the live chat's been in a while. You guys are saying all sorts of wild. It reminds me of the old days. So team, again, make sure you guys are hitting that like button on the way in. Makes it a lot easier to find the streams when we do them every day at 9 a.m. We have a lot of fun over here. But yeah, see, I don't know what they do. Can I look up like a profile of them? Yeah, so it's a covered call ETF. So it employs a covered call strategy aiming for a balance between generating income and participating in potential gains within the tech sector. So if that's actually the case and they are making that statement, then they have to be selling some deeper out of the money covered calls. Now, if they're not, then that's a blatant lie and they're probably going to have some issues with the SEC. So, which is definitely possible. Specifically, the fund holds the stocks of its benchmark sole active FANG innovation index. That's fine. Right, slightly out of the money call options on them. That's fine. Depends on how far out of the money and what the expiration dates are. This approach capitalizes on the volatility of big tech firms that is reflected in options premiums. All right. I mean, that's fair. Like depending, I mean, I bet they're doing it with like Nvidia, like all the other tech names that have went crazy. So, I mean, that's fine. If they're selling out of the money covered calls, the problem is that if the covered calls are close enough and the stock drops, the problem is that you never get your principal back. You can't find this on MetaTrader 5. That's because I trade future stocks and options. I'll say this now because all you guys are coming back in here. Guys, I trade future stocks and options. And if you guys have the ability to trade either futures, stocks, or options, like you should be. So this one right here, the problem with these covered call ETFs is that if they're selling the premium too close and the stocks drop and those contracts get rolled over, they're then what are you calling it? You're then never going to get your principal back because if the stock goes up and hits that exercise price, you're just going to get taken out. And then it's going to be very, very difficult for you to get back your actual premium. What's my position to average on AMC? I don't have anything. I told you guys that it was going to die when it was at 18, when they released the ape nonsense and everybody didn't listen to me and they were sending me death threats. And then I said, okay, watch what happens. And then it dropped and everybody got mad, but like I'm still alive. So it's garbage, man. It's garbage. When they tried to do what they did, I was screaming it from the rooftops. And everybody was like, no, let's listen to the people that don't have any experience with anything. Let's listen to those guys. It's like, okay, learn your lesson. In Japan, what's up? What's up, everybody? How are we doing? Yeah, Frank, I don't hate that. I always look really deep into covered call ETFs, though, just because they can get a little wonky. And that's the one thing I always worry about with them is that if they're selling premium too close, if the stocks drop, you can't get back up to your initial investment. You're just going to get like you're just collecting the dividend, which may not be enough to counteract the actual principal losses. All right, guys, we have less than a minute to go here. We have like what, 5 seconds? 4, 3, 2, 1. Interest rate decision incoming. Here we go. Do I have a Discord? No. What do you call it? Yeah, you can message me. If you guys want the courses, again, they're 50% off right now. The 15 winning months in a row, day trading mastery course strategy, the Swing Kings course, whereas where you guys are getting all the multi hundreds and 1,000% gainers that I'm putting on the watch list. Like, again, we can talk about that in a little bit though. We've got more important things to talk about right now than my courses. Like, what the? Why are they labeling it like this? Yeah, Fed holds benchmark target rate in 5.25% to 5.5% range. Yeah, so no change. This is interesting. FOMC median forecast shows 75 Wow, they kept it where it was. Oh, wait, hold on. Median rate forecast for 2025 rises to 3.9 from 3.6, but they're showing the median forecast shows 75 basis points of rate cuts in 2024. That looks like it's the same. Fed repeats waiting for greater confidence on inflation to cut. All right, pump it then. These numbers are really bullish. I agree. I agree. All right, swing season's back on, maybe. If we hold up here, let him rip. Let him rip. Now, DraftKings, get off your you-know-what and go back to our target. How about that? Yeah, let me go back so I'm not reading it on my phone. Let me see. You guys, get out of my Twitter replies with your nonsense poop coins. All right, let's see. Yeah, unchanged. I think that's crazy. I think that's a little bit crazy. Fed projections show 2024 policy rate view unchanged at 75 basis points of reductions or 325 basis point cuts. So that means June is still on. Look at this thing react here. This thing is going. This thing is going. That is interesting. That is interesting. Hold on. I want to see if I can snipe something here. Not on this. Just something else. See if I can get a crazy fill. They might give me that. I'll leave that there. Yeah, I mean, my DraftKings are back up 115% after the scale outs at 300% earlier. We'll see what happens with that. Let's see. TLT had a nice candle. TLT is probably reacting very positively to this. This is TMF right here. Throw this back on the weekly. Yeah, it's not moving that crazy. We can get TLT back on here. But so guys, TLT, for you guys that don't know, is the 20-year Treasury ETF. So we were getting long on this thing down sub 85. I was screaming it from the rooftops on Twitter. Again, pay attention or pay a premium, ladies and gentlemen. And again, as you guys are filtering in here, make sure that you guys are hitting that like button. It helps out a whole lot with the algorithms, getting these streams out to some more people. We have a very, very, very interesting afternoon ahead. We've got 27 minutes to go to round 2 of the Fed meeting when Jerome Powell gives us his prepared remarks and we get that Q&A session. Give it some time for the statement to hit the LLMs. They're pretty quick with it, man. They're pretty quick. How big is this candle? 20 points. That's not bad. DraftKings trying. Yeah, they're not letting me get out of this. Whoop, whoop. What's up, Michael? I know what you did. I know what you did, buddy. Please don't do that again. I know what you did. It just wasn't smart. All right, let's see what we're gonna get here. Let's see what we're gonna get. You guys are slacking hard on the like button. I see how it is. But let's see. Yeah, I mean TLT. You look at this on the weekly. It's setting up again. This has a nice little interesting setup here that I'm interested in. I'm kind of done. Like TLT, I've kind of already have what I need. TMF though is the 3 times levered version of this, so I'd be interested in doing something with that. KRE is getting a nice pop. Let's see. I want DraftKings to get spicy up here. Go up $1, and we're gonna have some fun. Got trader community. I don't know. I don't trade Forex. I don't think if you have the ability to trade future stocks or options and you decide to trade Forex, I think that's a silly decision. The brokers are terrible. They're like the prop firm stuff. They're always scheming you guys. Like, they're playing around over here. Palantir, though. Palantir, nice move. Where's NVIDIA? Okay. Hot Potato, what's up, buddy? How you doing? All right, man, let's see. Come on, DraftKings. Go back. Go back. We already hit our 300-something% scale out today, but I want more. I want more. Yeah, those that free position's up 120% right now. That's pretty good. That's pretty good. Ooh. RKT. Oh, we're getting a lot of alerts. You guys might have a lot of alerts. Like there might be a lot of alerts that fire off during Powell here. Yeah, it's going. What's the range on this? I don't hate this at all. Is it 13, 50 cents? Let's call it 50 cents. Ooh. Oh, that's true. Yeah, that's true. I kind of like that. I mean, this is like a mortgage rate. This is like a rate play. Like RKT's a rate trade off of this. Huh. You been good? Yeah, hot potato. I've been good. Yeah. Let's see. I kind of want to take a stab at it, but I also don't. I kind of want to wait for it. KRE is getting a nice pop there. I ditched that. I ditched. I want DraftKings to get going. SPY hit the top of the range at 518.39. Did it pull back? No, but how big is this now? 27 points. Oh my, that's new all-time highs. Yeah, that's all-time highs in the market here. Huh, interesting. On the road, what's the word? No, obviously they didn't change the interest rate. They left it unchanged, but they're still pricing in like 75 basis points of rate cuts in 2024, which to me is very interesting. Very, very, very interesting. Let's see. Let's see. All right. Yeah, RKT's coming down. I mean, I'm interested in it. I don't want to willy-nilly start buying stuff off of an initial reaction on Powell. I am interested in NVIDIA, though. I think NVIDIA could have some fun this week if the reaction continues to be positive. But yeah, other than that, I mean, what else do we have to look for here? This good or bad for the market? Currently, it's good. Is it great for the overall economy? I don't know, man. I don't know. That's an interesting one. Let's see. Dude, I love some of these tweets that I'm seeing. One of them from this guy on Twitter. It's like a dude holding a sign, and it's just the Fed doesn't care what you think they should do. I love it. They don't. I mean, the interesting thing right here is that everybody is expecting the Fed to be a little bit more hawkish here. Now, Powell can still come out and change his tone. That's the interesting part about this, is that Jerome Powell can still come out and be a little bit and lean into that hawkish narrative a little bit while still, because basically what he's doing is, if you think about it from both sides of the coin here, where people are expecting either delayed rate cuts or somehow a rate hike at this point, which would be catastrophic for regional banks. But on both sides of the coin, they're leaving both options open. So they don't want to spook the market and cause any more volatility that's already in the market. So what they're doing is they're going to say, all right, well, we're going to leave our expectations where we are because we've seen 2 rounds of decently hot data. But now what they're saying, that what Powell's going to say is we're still going to be very data dependent. And that's kind of what came out. So we have this initial reaction. I mean, again, I'm kind of happy I'm not starting to willy-nilly buy things yet. But I mean, I'm interested in RKT. That's a rate play. As rates come down, rocket companies with their mortgage branch can definitely do a little bit better. KRE, I mean, is going to move around a little bit. So that was kind of like my longer dated Powell hedge and then DraftKings was amazing today. So we'll see what happens with that. 210. What is it right now? What's the inversion like right now? It wouldn't have uninverted. It probably would have gotten a little worse, I think. Here's from Nikki Leaks. A steady upward drift in expectations of the long run Fed funds rate by committee members finally and barely lifted the median projection in March. The median was at 2 point. Why is the for what year? For what year? Nikki Leaks, what are you talking about here, buddy? I mean, let's see what the rate expectations are for June now. It was 60% this morning for cuts in. Hold on. Why is this screwing around? There we go. Hold on. Yeah, May 93% chance we don't say 64.5 that we cut in June, which makes sense. That's right in line with our expectations too. You come from TikTok. What's up, man? Was wondering what is it that I'm doing and is it accessible to everyone? Yeah, it is. I mean, I trade and I teach everybody about the market. A lot of what I do on TikTok, again, I can't explain to you the knowledge that I have in a very quick TikTok video, but if you come around and hang around these streams for long enough, you are going to learn a metric boatload, not only about trading, day trading, swing trading, but overall about the market, the macro economy, and things like that. Let's see. Yeah. Oh, all of you guys too. We have our mastermind number 4 tonight. That is going to be awesome. That is going to be absolutely insane. I can't wait for that. The mastermind tonight with you guys is going to be insane. Let's see what else we have here. Yeah, it's just the Nikki Leak stuff. What a safe word is. I don't know. Stop. You guys do all sorts of weird stuff on the stream. Why is Telly coming back down? Is it reacting off long? So yields are coming up. Market's holding. That's interesting. Mastermind ready? There you go. When does Powell speak? At 2:30 p.m. Eastern. Loving the mastermind? Oh, thank you, Daily Taylor. And again, guys, for those of you guys that aren't ready for the mastermind level content, all the education that I offer, the day trading mastery course, that with that strategy, I mean, you guys have seen it. It's got 15 winning months in a row. The Swing Kings course, you guys get buy one, get one free. It's 50% off. So if you guys are interested in that, the link's at the top of the live chat. I can throw it in here for you guys too. But if you're curious, just ask anybody what their experience has been like. I know most of you guys who have tried to learn from people on the internet in the past just basically learn absolutely nothing. But that is not the case here, as you will find out. Let's see. You're going to try to make the live class tonight? Awesome, Michael. Yeah, I know not all of you guys can make the live session of the class, but I've seen you guys coming in, watching them after. That's awesome. Good for you. Taking advantage of that info. What are we, we're on our second week. I think it's going to go the full 10 weeks. The amount of stuff that we're going over with you guys in there is going to be insane. So let's see. Oh, it's a little hot in here. TLT got slapped. KRE overreacted. I think it did, but because what do you call it? The overall, like for next year, the rate expectations went higher. Let me see. Where is it? Here it is. Yeah. Oh, wait, no, that was the inflation expectation. So the FOMC median 2024 core PCE inflation estimate is up to 2.6 versus 2.4. Guess what, guys? That's not 2. That's the interesting thing that I like. My interesting point about this market right now is if you look at long run inflation, like, yeah, PCE might be around 2, but if you look at overall inflation over like a long enough period of time, and the Fed says a 2% inflation target, it's not 2, it's actually around 3. So when people are saying, oh, they might move the inflation target up to 3, like, I get why, because of all the money that's been printed and we're starting to see hotter inflation. It's going to be harder for them to hide that data coming out. But like, they almost don't even need to do it because it's there anyway. It's like, I don't know. It's a weird one. Rate expectations for next year have been reduced, which is like why TLT got slapped back down. Expectations for more cuts is what I'm guessing you're saying. The federal funds rate would remain a little higher, which is why TLT would get slapped back down off of that initial pop. Oh, That was an interesting. Whoa. ES. What are we doing there? Getting a little squirmy there, huh, buddy? Nvidia's up a little, but like it gapped a little, so it doesn't look like it is. KRE, ES. I mean, DraftKings still had a great day. I'm gonna leave that one. RKT selling back off. Let's see what we get. Oh, we are like 32 likes away from 100 on the stream. Thank you guys. I appreciate that. That is awesome. That is awesome. All right. Not surprised there's popped and drop. Oh yeah, no, I'm not surprised yet. Especially with the rate decision coming out. TLC's gonna move like crazy. Oh, where's oil right now? Where's oil? That's interesting. Whatever is going on with this. Where is oil on the oil's down 2% today? That's interesting. Huh. ES wicked that all-time high. Let's see. I mean, it depends. When Powell says good afternoon, you never know what's going to happen next. $100 likes to extend the stream an hour. No. That's only for the mornings. You guys are already getting a bonus stream today with Powell. Someone remind me how to like a live video. I don't know. You turn it vertical and you hit it. I don't know, man. It's a tough question. That's almost as bad as some of the questions that I get on like Instagram and TikTok. That's like, what time does your stream start in my location? I don't know, man. If you have the internet, which I know you do because you're messaging me on a device connected to it, search it on the internet. That's not my job. Like, I don't know why everybody thinks I'm the time person. I don't even know what day it is most of the time. Just kidding. I know what day it is. All right, let's see. Where's ES? See, this period between when we see that like initial move off the so no trades. No. It's Powell day. Why would I be trading right now? What do you think, I'm a gambler? No. Let's see. All right. Whoa, TLT is getting rocked. That's interesting. Nice one. Are you being sarcastic in my live chat? Is that what we're doing? It is Powell day. We have Powell in 13 to 12 minutes. People really tuned in to watch you YOLO at FOMC. Yeah, guys, that's crazy. Why do you want me to do that? Yeah, it's watch and learn time. It's not trading time. No, I'm for real. Oh, okay, cool. I don't really have a rant prepared for this afternoon. I think we already kind of did it. You bought a put for the like this time? All right, well, the calls paid out this morning on the like button, and the puts I don't think they're going to pay out this afternoon, but I can't wait for all the new Powell memes that are going to start popping up, like with the voice AI over them. Those are like my favorite things in the world to watch. Full port it? No, actually. How about we don't and say we did? All right, we're gonna do that instead. I feel like here's my rant. I feel like everybody just wants to lose money. Like, I feel like that's really what it is. Like, deep down in your heart, you're just like, I just want to lose all my money. That's how I feel most of the time when I see most of the things happening on social media. Like, seriously, they're like, oh, let's trade Powell. And it's like, no, you just want to lose money. Like, no long-term vision, no back-tested strategy, nothing. They're just like, gamble. Okay, all right. That's what you want to do. Go for it. You guys see it in a lot of the in the live chats too. It's like, you got us. I know. I feel like you guys are lying. You're like, oh yeah, I'm gonna take the courses, the 15 winning months in a row strategy, the Swing Kings course where you show us the multi 100%ers. Yeah. Making money sounds all right, but you know it sounds a lot better? Losing money. Like, that's how it feels most of the time when I see crazy things come into the live chat and like my comments and messages on so they're like, I want to make $100 right now. And it's like, well, you probably shouldn't trade. You should probably get a job. That's just the honest truth. Yeah, it's nasty. And I show you all the trades in it. The average risk to rewards on it is like a 1 to 6-ish. It's got like a 35-ish% win rate. It's dirty. It's dirty. But then I just show you all the trades that was taken with it in a year. All of them. You guys want to learn that if you guys want to have less fun in the market and decide that you want to leave your past behind of wanting to lose money, you know where to go. Let's see. Yeah. All right, guys. Well, all right, let's be a little bit more serious here. I'm going to grab a glass of water. Give me 2 seconds. Let's see. You made $30 with $10 of margin. That's getting dangerous over there. Give me like 2 seconds, guys. I just gotta grab a glass of water. Keep smacking that like button on the way in. We're gonna get ready for Powell. I didn't realize that all the degens were coming to my stream today. Oh my god. All right, we're back. We're back. Let's see. Well, sometimes you just want to have fun, like up 400% since January. I know, Ben, you've been killing it with the swings, dude. Absolutely crushing it, man. Shout out to you, buddy. Let's see. Let's see what the news feed's looking like. Nothing. Anything on Twitter? I don't see anything. Let me see. Yeah, I mean, the inflation numbers are interesting because if you look at Supercore and some of the other things in there, I mean, yeah, they do have a point, but it's not a good point. Let's see. CBU, if that's the style that you like with Titan, go for it, man. Titan solid. Let's see. I want to see if DraftKings can get up to that level, 45.60, another $1. That'd be fun. That'd be fun. Yeah, guys, there's going to be no full porting, no gambling, no nonsense. Everything's data-driven. You think about the long-term vision, you make your money, and you're done. None of this like hyped up nonsense that I'm going to come out here and say, I'm going to make you guys rich in a month. That's crazy. That's crazy behavior. Let's see. All right. Inflation message. Traders price in additional Fed easing in 2024. It almost feels like people are just like degenning the federal funds rate expectations. The Fed has almost lost their credibility. It's like what are they going to do at this point? Oh yeah, inflation's transitory. About that actually. Janet Yellen last week comes out and says that, oops, I'm sorry for calling inflation transitory. Even though she's not a Fed member, obviously, but does have some influence about what's going on, even though they say that she doesn't. Then you have Powell talking about that long run inflation target, things like that. Almost? What do you mean almost? Almost. Think about it. You could full port pool one time and never have to stream again. Retired. Yeah, no. Actually, that's not how that works. It just doesn't. No. Yeah, so you're saying we should all do it, and then all of us are somehow going to make a bunch of money, even though it's a giant Ponzi where people are just moving money back and forth to each other. You haven't seen me around for a while? Dude, I've been live every single day for like the last, what, like 3 months here? Again, guys, we're live every single day, 9 a.m. We've been cruising. We've also been popping off on Instagram and TikTok. That's been crazy. Thank you, guys. I appreciate you. Like some of my TikToks have like 500,000, 900,000 views. Instagram goes nuts too. So thank you, guys. I appreciate that. All right. We got 5 minutes until Powell. Hood's nearly at 18. That's interesting. RKT with a little sell there. I kind of like it down there better. Yeah, Austin, you know what I also could do? I could full port 0-day SPX contracts. It's the same thing. Like, why are we gambling? Like, you want to gamble, go to the casino. That's not what the market is. Thank you, SCV. We appreciate you. I appreciate you guys too, especially those of you guys that don't shill meme coins in the live chat. All right, we got 4 minutes. I've got the link up, ready to go. There's gonna be some elevator music over here, but you know, we get to see Powell. No, I'm not actually gonna full port SPX, guys. That's crazy. We talked about this morning on the live stream, but if you actually want to have success in the market, you got to think based on logic and data. There's two things that you need to think about. One is logic. Logically speaking, everybody knows what they should and should not do in the market at any given time. And there's also, it's very easy to identify the actions that failing traders take. It's very simple. Over risking. Revenge trade, doing all of these terrible things, having no strategy, just gambling on what do you call it? Like FOMC, things like that. So it's very, very, very easy to say, okay, this is what all of the people who are failing do. Don't do that. Like, and then you can fine tune it and say, okay, well, which strategies are solid? If you guys want mine, I mean, you guys know where to get them. Those are all data driven, tested, very simple to understand for everybody. So let's see. 11 likes away from 100. Thank you, team. I appreciate each and every one of you guys coming in here. Even you crazy people. It makes it fun. You know, you want commentary during Powell time? You'll get some. You'll get some. Let's see. I think we're all set up for it. If not, you know, we'll fix it. We'll get Powell going. If it's not calculated, yeah, exactly. Doing the same thing over and over and expecting different results equals stupidity. Man, I just changed video quality from 144 and can finally read your screen and see your face. Hi. What's up, bud? Was Hot Potato in here earlier? Yeah, he was in here for a minute. Let's see. It's good to see all you familiar faces in here. It's fun. Do you think Powell will be hawkish or dovish? I think Powell is I think he's going to play both sides, is what I think. I think Powell is going to reiterate the potential for 325 basis point rate cuts, but then also kind of trying to stifle the market's expectations and point to the hotter inflation data that we've seen. And I think it is a guarantee that he is going to get asked questions and potentially multiple questions about his thoughts on the recent CPI and PPI reports that we've had that have shown that inflation is picking back up a little bit. His reaction to those questions is probably going to be, well, you know, January seasonal factors, this, we recalculate this, it was shelter and all those other things. But he's going to play both sides and say, well, you know, we still have to be very, very interested at what this data is going to trend going forward. He's not going to leave. DraftKings is pumping. Not really. I mean, sort of. DraftKings was a great trade from yesterday going into today. Scaled out a third of my position at like, I think it was 270%, made the whole thing free, planning to sell a quarter of what I have left if we can get up to 45.61. But if not, I don't care. The position can go to zero. Basically going to say nothing. He's going to say things on both sides. Here's what he's going to say. So that's kind of my expectation. I mean, I don't know, Nate. I know he's going to say good afternoon, though. It's like my favorite part of the Fed day when Powell tells us good afternoon. It's great. The funniest thing have been like the TikTok edits of like Powell walking up to the stage and saying like good afternoon, and then it cuts to like streamers that trade that are just getting like taking huge losses. Oh, here comes ES again. All right, here we go. I don't see him yet, but he's coming. He's coming. It's Powell time, ladies and gentlemen. So again, team, if you guys wouldn't mind hitting that like button on the way in, helps out a whole lot, spreading these streams out to some more people. I'll try to give you guys a little bit of commentary as we head through. If he says something really important, you can watch me on the little corner of the screen. I'll kind of cue you guys in and say some stuff in the live chat that if they say something important, you'll definitely need to pay attention to, and I'll try to break things down quickly to all of you guys as well. And again, if you have any questions, let me know. Did I trade Mara yet? Oh, no. Mara has not given me what I need to see at all. Oh, here he is. All right. Let me know if you guys can hear him in like 2 seconds.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. What? But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year.
What's unemployment now?
Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets.
So what did they
see? The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2020.
All right, hold on. The interesting thing about this is that they've said two really interesting things. And he's kind of said this before, but at this point, it's very strange. He's saying that the economy is expanding at a solid pace, but he expects that to slow down. The key question is why? What do they see that we do not see? Now, along with that, if that's the overall basic assumption, and now they're saying, because the last reading of the unemployment rate was 3.9 is what I just saw. And then, it's like he didn't read the data before he started talking. Exactly. Yeah, it's kind of strange. But then they expect unemployment to go up. Well, how is that going to happen if you're starting to see lower and lower people for filing for unemployment benefits every single time the jobs report comes out, which then we're going to be getting another one tomorrow morning. So if that is the guidance that Powell is giving, we need to pay attention to that. Pay attention, everybody. So sorry, I'll put Powell back on, but that's important if they expect unemployment to start going up.
We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks.
What does he see?
We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
That's key. Watch the market.
We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings, consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Here we go. Q&A time.
Mike for me. Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average, rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming as I pointed out in my opening remarks. We did mark up our growth forecast, and so have many other forecasters. So the economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down, and so.
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
We're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that.
No, they don't. No, they don't. Markets do not believe that. That's a very, very key point. Markets do not believe that Powell is actually going to be able to get to his 2% target. They believe that inflation is probably just going to be higher for longer, and the Fed, with the soft landing, is not actually going to be able to get it there. That's why, because when you look at all of the data in totality, you'd have to be an insane person to say, oh, with the labor market where it is, at unemployment at 3.9, and then inflation starting to pick back to the upside, if you then think that Powell is then just going to magically get inflation to 2%, you're nuts. So what he's actually saying, let him misguide us. No. This is important. So what the market's actually saying is, we think that you are basically going to throw in the towel and let inflation run higher for longer. That's what they're saying. Not that they actually think. There's two interpretations of that. In mind is a 30-month range of 2%. Yeah, true. But if they start cutting too early and you don't see that continued progress, that's not great.
Affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rate.
If Powell, what I just said in the last little kind of break that we had there, if what the market actually thought was what Powell had said, you would not see TLT reacting like this. You would see yields coming down. You would not see yields going up. That wouldn't make sense.
Followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995.
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment and, people's working lives. And so, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
Good question.
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
All right, fair. You got to do something.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
You said it's possible.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
Just a question of, is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period. If you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Rieger at Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about why might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic post-global financial crisis era for reasons that are mostly important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero. In some cases, I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already or you mentioned it being 2.8 in February. That doesn't sound like much disinflation at all. So are you still confident? Or the last press conference, you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen
Oh God,
2023 is
sorry.
that one?
I think that higher year-end
They're all gone. They're all
number
gone.
reflects the
Excellent.
data we've seen so far this year, because you're now
Now when I
in
like
this
the
year.
best.
So I think that. Sorry, say your last part of your question again.
Read that.
Well, just, are you still optimistic
In
that
this.
you'll get the confidence you need this year?
I think if you look at
That's
the
important.
SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts?
Yep,
And
listen.
just in general, if labor supply
Great
continued
question.
to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on
Great
policy?
question.
Yeah. So if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year, with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts.
No, not all by itself. No, I mean we saw you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason for us to be concerned about inflation.
Neil. So then why say 4.5?
Chair Powell, Neil Irwin with Axios. How do you assess the state of financial conditions right now? And in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McKee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking, and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So the Then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger. This is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now. And we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Go to Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Hi.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed just to understand that book. So I treat dissents with real respect as well.
Here we go.
Simon.
New candles.
Simon Rabinovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea. That's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
No, Alan. Oh yeah, there we go. Come on.
Hi, Victoria
Hit it.
Guida with Politico.
Okay.
Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink, that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserve situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops near at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Jean.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower, you can get farther. But that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We're we want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and, buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. Of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Well, are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of the CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. It has applications in wholesale finance, in the payment system. And so we to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress.
Wait a second. Tinfoil hat time for 2 seconds. What if all those people that were trying to pump the Powell coin is literally just the CBDC? I'm just kidding. All right, back to work.
I just think it's something we need to understand. And we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Mark.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that. So Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8. So now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times. So those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year. And what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE coming down by 10% every month, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Is that it? All right, ladies and gentlemen. That was pretty crazy. Nice little take profit too, hitting on DraftKings. Those, what do you call it? The RKTs are looking good. I could have actually grabbed it lower when it was at like 1280, 85 or something. I just wanted to see how that actual reaction was going to be. From the overall FOMC, I mean, this is a rate sensitive trade here. So it is interesting that TLT is holding. That's kind of why I held off on this. I don't know. It's looking good right now. They have a little bit of, oh, shoot. I got to answer that. All right. So team, we have, what do you call it? I mean, those are up 47% right now already. That's pretty good. The new RKTs. Oh, the DraftKings are up 345% right now. Oh, thank you very much. So, guys, that's probably going to wrap it up for me. I mean, we're live every single day. Remember, I'll see you guys tomorrow at 9 a.m. Everybody that's already in the mastermind. I mean, we have our fourth mastermind session tonight. I'm going to be sending you guys that link pretty soon. And then again, as always, you guys want to hop into the courses, get 50% off. That link's at the top of the live chat there. Very interesting out of Powell here. I mean, again, he did everything that we thought he was going to. He played both sides. The interesting thing that I heard, though, was that he was talking in the beginning, which, remember, I said this was a great question from that reporter there. He was saying, like, he expects that unemployment's going to get up to 4.5% and growth is going to slow. So first of all, my question is, why do you think that? What does he see that we don't see right now that's causing him to still be on that side of 3 rate cuts of 25 basis points each this year? And then when asked the question, well, what happens to your expectations if you see stronger job growth and unemployment doesn't get to those levels? And he was like, well, I mean, it's not that important. And it's like, all right, so then why would you say that? So every single thing here that's coming out is really kind of hurting the Fed's overall credibility. So again, we'll talk about this a little bit more tomorrow morning on the live stream. For those of you guys that are new, welcome to the channel, welcome to the stream. I will see you guys later. Peace.